Hello, everybody. Welcome to Idea to IPO. My name is Roger Royse. I'm a partner with Haynes Boone. We're an AmLaw 100 law firm. I'm based in Palo Alto, California. And today we're going to talk about how to prepare your startup for venture capital investment, part 2. So if you were here with us a couple of weeks ago now, you would have heard part 1. That was our Thanksgiving special. This is part 2, our Christmas special. How to prepare for venture capital investment. So people are still rolling in. So while they do that, let me just set the stage for you a little bit. Thanks for being here, first of all, everyone. Thank you, Idea to IPO, for putting this event together, this virtual event together. I'm your speaker today. I'm your sole speaker. I'm also my own introducer, Roger Royse, Haynes Boone, Palo Alto, California, heart of Silicon Valley. Now, a couple of things. I am recording, and I am going to send a link with my slides and a copy of the recording to everybody who is signed up for this event. So you'll be getting that after the event, hopefully by the end of the day today, maybe sooner. You'll be invited to subscribe to my YouTube channel. I hope you smash that subscribe button and subscribe, because we have tons of content, hundreds of hours. I'm not kidding, hundreds of hours of very relevant information on startups primarily, but everything related to startups, venture capital investment, technology, even politics, anything that touches the business community, philanthropy, pretty much anything, but you'll find lots and lots about startups and venture capital and how to prepare for investment. So please feel free to do that. Our agenda today, I am going to present for 1 hour until 10 o'clock Pacific time. I'm going to go through my slides. I've never in my life gotten through all of them. And at the end of the hour, I'll take questions. If you have questions while I'm doing the presentation, use the Q&A box and I'll get to them at the end. Use the chat box to chat. We'll talk to each other. If you have immediate type questions, but if you have a question you want me to actually answer, use the Q&A box. It just makes it a lot easier to organize. If you'd like to see the slides and the recording for part 1, just go to the YouTube channel that I'm going to post here in about a second, and you'll be able to access it. Or if you email me, I'm happy to send you a copy of it, along with a copy of my last book. By the way, you'll be happy to know that I have finished and have sent to printing my latest book. It's called 10,000 Startups, Strategies for Legal Success. It will be out by Christmas, although that's only a week away, but okay, maybe not out by Christmas, but soon after. But it is in the hands of the printers. It's in printers' hands now, but the book is finished, 10,000 Startups. Don't worry, you'll be hearing about it. We'll do a social media campaign and you'll hear about it certainly if you attend future events. And in fact, once we get it into an ebook form, I'm happy to circulate an ebook to anybody who wants to join these events. If you're tweeting, use hashtag Idea to IPO, and that's the word 2 spelled out, Idea to IPO. Make sure you follow us on Twitter, join the LinkedIn group, find us on all our social media, etc. All righty, now before we get started, okay, we're 8 after the hour, so I think that's enough time. I'm going to give you my links so you can find me, you can find the LinkedIn group, you can find, oops, I did not post a YouTube channel. Here, give me a second. Hyperlinks don't really come through very well on this. All right. Well, while you're doing that, let's do a couple of polls. Let's find out who's in the audience here. So first of all, who is in the audience? Are you a startup entrepreneur? Are you established or mature company? Are you an investor? Are you a service provider like me? Are you a student or a professor? Maybe you're in government. Maybe you're in press. Wow, mostly startup entrepreneurs. Well, look at that. We've got a handful of people from more established companies. We've got a handful of investors, a little bit of almost everything else. No one from government is here. No one from the IRS is here. Good. Actually, this is valuable feedback for me because it does inform a lot of the way that, I'll present and which slides I might spend a little more time on. So, so there's a reason, there's a reason, a method to the madness. So with 73% participating, we have about 70% startup entrepreneurs, 10% are mature companies, about 8% are investors, 8% service providers. How about that? And a few people from academia. Okay, I'm going to end the poll. Let's see. And I'm also very nosy about where you're all from. This is a global platform now. This is being broadcast all over the globe, all around the globe. So I'm curious as to where people are from. Again, that informs a lot of what I talk about. If I get a lot of North America, I'll talk a lot about North America. Okay, Silicon Valley is about 15%. That number gets smaller and smaller every time we do this. I think people are leaving or something. Other North America is 55%. That number gets bigger and bigger every time we do this. Asia is 10%. Good. It's probably because of the time. Western Europe, 13%. That's good as well because of the time. We have someone from Latin or South America. I'm really surprised. Very little representation from Eastern Europe, Russia. I know there are people from South Pacific. Anyway. Well, with 72% participation, we have more than half other North America, 13% Silicon Valley, and pretty good representation, 10 and 13% Asia and Western Europe. Good, thank you for that. And the decrease could be due to California taxes. Tell me about it. All right, so let me, okay, now I am going to share my screen, take us over to the slides. So give me a second here. All right. All right, I think it's working. Awesome. Okay, thanks everybody for being here. Again, Roger Royse, Haynes Boone, Palo Alto. Today's presentation is how to prepare your startup for venture capital investment. So let's get to it. Okay, that's I don't have my usual disclaimer slide, so I'll just tell you that even though I'm a lawyer, this is not legal advice. This is just me talking about some of my observations from having done this for almost 40 years. And for what I'm seeing in the market right now here in Silicon Valley and worldwide. This is a VC. In case you were wondering, this is who we're going to be talking about today and how to get money from the VCs. First of all, if you should want money. Now, I said I wouldn't cover anything I covered last time, but I'm going to cover one thing, and that's my favorite quote from Randy Komisar: avoid venture capital unless you absolutely need it. So I want to start with that because I talk to a lot of people kind of all day, every day, and the first thing they say is, I've got an idea, where can I find a venture capitalist? And that's great. You may have an idea. You may not be ready for venture. We talked a lot about that last time. I'm not going to spend a lot of time on that now. Instead, I'm going to assume that if you're here and if you saw part one, you've already determined that you are a candidate for venture capital. Okay, so let's just start from that position. Now, I just want to point out again that we're sitting in like record times here. Global venture funding hits an all-time high in the first half of 2021. That's globally. And I'll talk a little more global than just Silicon Valley centric, given our audience. But these are big times. These are big times. There's big money. There's tons of money in the space. And it's showing up in terms of valuations and how many and who is getting funded. So keep that in mind. We went over this last time, but I want to mention it again, just to remind people from PitchBook, NVCA, Venture Monitor. Just look at the numbers. By the end of Q3, 2021 had already exceeded by far all of 2020, and 2020 was a record year. And it's not just VC investment that's up, everything's up. Impact capital, which we talked about last month, that's impact investing, ESG, is way up. Angel seed funding is way up. Late stage, early stage, everything is big this year. It's a big year and it doesn't look like it's going to change. Here's the latest numbers out of Crunchbase for November. You'll see that November was a record month in global funding for seed venture, private equity, and venture, $65 billion. That just gives you an idea of the entire of the sort of environment we're in right now. And what that ought to tell you is that there's never been a better time to go out and seek venture capital if you're a candidate for venture capital. I don't want to spend a lot of time on this because we covered it last week, but I do want to, before I stop talking about market metrics, even the economists last week, 2 weeks ago, global venture capital made the cover page of The Economist magazine. And let me tell you what it said, because it's pretty fascinating. I still don't know why they call it adventure capitalism. I guess they view it as more risky than other types of investment, particularly private equity. But what they said is that an unprecedented $450 billion of fresh cash floods into the VC scene. This turbocharging of the venture world brings significant risks, from egomaniacal founders torching cash to pension pots being squandered on overvalued startups. But in the long run, it also promises to make the industry more global, to funnel risk capital into a wider range of industries and make VC more accessible to ordinary investors. So there you have it, the good and the bad. Since they're a reporter, they got to give you both sides of it, but definitely more accessible. Okay, let's kind of jump into the meat of things. So where I like to start, before we talked last week about how to meet a venture capitalist, how you should get that warm introduction, how you can find them, how you can decide who's right for you and whether you're right for them. Now let's talk about what would happen when you actually want to make that approach. So rule number one, in fact, I'm going to modify my rule number one right here on the spot. But I used to say your first contact with the VC should be an executive summary, just one page. Here's a good template. You will find a copy of this in my new book, by the way, modified from this, so it's a little more user-friendly. But really just one page. You know, VCs, they see so many deals. They're not going to spend a lot of time reading a pitch deck or, for God's sake, a business plan. So I like to start off with an executive summary. But I said I was going to modify my rule. I think I would go one step before that these days, given what the market is like, and start with maybe a better narrative, a better elevator speech, if you're meeting somebody in person or by email, something that just right to the point, just describes the problem that you're solving and who you are and how you're going to solve it. Then you can go into the just the facts, ma'am, executive summary, and it should be just the facts. And the number one fact is, first of all, are you at a stage and in a sector that the VC is interested in, right? What is your industry? What does the market look like and how big could it be? We talked about this last time. Can it be one of those really big companies that VCs like? And then I also like to mention team and IP and then whatever traction or financials that you have. But just the facts, start with an executive summary. Don't start with a pitch deck. You will, of course, move on to a pitch deck. And we talked about this last time, so I'm not going to spend a lot of time on this. I will tell you that there are a lot of people out there that can help you with a pitch deck. You want your pitch deck to be very professional. If you get to the point where you can get a meeting and you have a VC that wants to see a few slides to help illustrate what you're doing as part of that conversation, you should have a pitch deck. Now, your pitch deck is not a presentation. Don't think of it as a presentation. Think of it as a dialogue. That's a much better way. You'll have much better results. And again, you're going to expand on what's in the executive summary, but in particular, just the two takeaways I'd like you to have, because you will find tons of good material on what a good pitch deck looks like and what it should look like and how to do it. I just want to tell you two things. Number one, don't put your valuation in any of these written documents. I think it's a mistake. I think the VCs are, best case, they'll ignore it. Worst case, they're going to take whatever number you have and cut it in half. And that's how it's been explained to me by VCs. So I wouldn't do it. I would let them come up with a valuation. I've got a hack for you if they ask you to put a value on your company. But in terms of starting out, let them value you, not the other way around. It's just negotiation 101. And secondly, like I said before, it's got to be a good looking presentation. It's kind of like dress for success. My first job in Fargo in 1984, I remember the first week my boss came in, he handed me a copy of a book called Dress for Success. I don't know why, I'm about the last person in the world. I figured at the time that needed it. I had really good corduroy. Anyway, one thing I remember from the book, it said, if somebody's focused on the way you're dressed wrong, right? Same thing with the pitch deck. If they're sitting there kind of figuring out how you designed your deck, you did something wrong. You want them focused on you, the team, the technology, the product, and how you're going to change the world. So professionals are expert at doing that. Not to spend too much time on this because I want to get to meatier stuff, but your pitch really should be your mission statement. It should be the problem that you're going to solve. You hear that a lot, and that's a real thing. You solve problems. That's what startups do. Your solution, and I like what the folks at Andreessen Horowitz say, it should be aspirin, not vitamins, right? You want something that is a must-have, not a nice-to-have. The opportunity, the competition, and I know I hear all the time, we have no competitors, we're so unique. So think of it as alternatives. What are you displacing? Something about the product and of course your business model. And most VCs will have strong opinions on all of these topics, so be prepared to back it up. Now let's kind of get into some of the, I guess, like I say, the meatier topics here. So number one, at the point that you go to a VC, and I'm going to circle back and talk about how you get there, but I'm going to mix it up a little bit for today because usually I do this presentation, I never get to the VC stuff. I spend so much time on the pre-VC, but I want to talk a little bit more about what's going to go on when you actually negotiate those deals. So first of all, you're going to do what they call a priced round with a venture capital typically. And that means unlike a convertible, which is a convertible note or a SAFE, a simple agreement for future equity, where the investor gives you money now and you give them equity at some point in the future. With a VC, you will typically do a priced round. And that means you are actually putting a value on a company and you're selling a percentage interest in the company. You're selling preferred stock. Now, I told you a little while ago that you don't give the VC a valuation. They give you a valuation. They give you a term sheet with a valuation. Every once in a while, they will ask you, to put a number on the table. If that happens, I've identified about 30 different ways over the last 30 years that I've seen people value their early stage startups, which are, as a practical matter, pretty much just incapable of valuation because they're too early. But there are methods for doing that. I have a memo on this. If you'd like to see it, email me. I'm happy to share it with you. It also will give you some insight into what the VC might be thinking and how they might be coming up with numbers for you. As a practical matter, I think what I've seen most often with venture capitalists when they value companies is not so much these sophisticated methods that I describe. I have seen that. And I've had those discussions and I've seen them go to just the nth degree of sophistication in terms of their models. But more than that, I've seen them say, well, look, you need X dollars. I need Y% of your company. Poof, Z is your valuation. It's just math. It could be as simple as that. And if you don't like that answer, and if you want to come back to them, you're going to have some support. So take a look at some of the alternative valuation methods for early stage startups that are out there. I want to, again, we're preparing for venture capital. So I want to pause on a couple of things here because I get this question a lot. Gee, I'm going to go do a crowdfunding campaign, or I'm going to do a crowd financing campaign, or I'm going to do something like that. How are the VCs going to view that? So let's pause on that for a second. And I'll tell you the reality and then the lore, I guess, or the fiction. So first of all, if it really is rewards-based crowdfunding, the big risk here is that it fails. If it succeeds, and it should succeed, otherwise you won't do it if anyone's even doing these anymore. But if it succeeds, it's a good thing. It shows traction. It shows the public likes your product and believes in you. If it fails, you've got a big problem because that's public. There are legal issues around this stuff. I'm not going to get into that today. What I really like to talk about is the crowd financing, because I get that question way more often. Because under current law, you can raise up to $5 million from basically the general public in the United, if you're a US company, and if you go through a crowd financing portal. And the law has recently changed to make it a lot more attractive to do that. Now, I will tell you here in public that there are a lot of very reputable crowd financing sites. Those are great deals. You can take money, and I've heard a lot of VCs say, well, we don't want that. We don't want 1 million shareholders on your cap table. We won't invest in that. But then they do. Then they do. Okay, I've seen that over and over. And the law has changed that we can consolidate these investors and put protections in place so that you don't have so many annoying investors that have small amounts that are very distracting to the company, because that's what the VC does not want to see. There's ways you can consolidate them into one custodial arrangement or SPV. Now, the other pro tip I'm going to give you, here's the other takeaway, is that I haven't seen a crowdfunding site get state blue sky compliance right yet. Okay. And I know what they all say. They all say, oh, crowdfunding preempts state law. This is all federal law. We don't have to think about state law. You couldn't be more wrong. Every state can impose a notice requirement if they want to, and they can impose fees. So you need a lawyer to do a crowd financing. I don't care what anyone tells you. You just do. And nobody's gotten in trouble for this yet. But oh, you wait. Let's talk a little bit about how you get to that venture round before we jump into the terms. So first of all, before you do a priced round, almost always, you will have done an angel round, you will have done a friends and family round. We talked a lot about that last time. And I want to just set the stage for this because this is going to inform a lot of what happens when you get to the venture round. You'll probably sell money in exchange for some sort of convertible instrument. Either the investor loans you the money against a note that they can later convert into stock, or we do this instrument called a SAFE, Simple Agreement for Future Equity. I'll talk more about these in a minute, but both of these instruments have a feature that they have a conversion feature. In other words, they're going to convert into stock at some point in the future, okay? That's what makes them very equity-like, and that's why investors will take that risk, because they're not looking for debt return, right? They're not taking debt risk. They're taking equity risk. They want equity return. It's just you're too early to value, so they'll value it when those instruments convert. Almost always, these instruments have a valuation cap. The valuation cap, which sets a maximum valuation at which the note will convert, or the SAFE. So in other words, if I put $100,000 into a company, and today it might be worth $1 million, but we don't know for sure, so we're going to use a convertible. Well, if you use my $100,000 to turn your $1 million company into a $10 million company, I've kind of worked, my money's worked against me because now it's going to convert at that higher $10 million valuation. So I'm going to contractually require you to convert at a lower value. These days, the numbers are much bigger than that, by the way, but you get the idea, right? I want my money to get a certain minimum percentage of your company at today's value, or something, not today's value, but let's say a governor or a cap. So in case we have a runaway valuation. I'll tell you, the first time I used this was more than 10 years ago. Convertible note, we put money in, the company had way less than a $10 million valuation at the time. By the time the note converted, they were at 40 million valuation. And the investor said, oh, well, that wasn't a good deal. I should have bought stock, a year ago at its $5 million valuation. So a cap protects you against that runaway valuation risk. Early investors get a discount, right? You get a super cheap price. You saw the future, you were in early. So usually it's 20%. It varies with the market, meaning that when the company does sell preferred stock, your convertible, your note will, or SAFE, will convert into that preferred stock at a discount to the price that the later investors pay. So usually it means every 80 cents of your money in today will get $1 worth of stock down the road. And then there are a lot of other provisions. Change of ownership, what happens if we sell the company before you do a financing, you should get your money back, Mr. Investor, and you should get in preference to the common, or you can convert to common, or sometimes you get a multiple of your money put in. I want to pause on this. Well, okay, briefly, shadow preferred. This is the idea that your safe money or your convertible note money, companies have gotten smart over the last 10 years. And what they say is, look, yes, you can convert at a discount. So your 80 cents buys $1 worth of preferred, but that doesn't mean you get $1 worth of preferences. We'll talk about preferences in a minute. It means you get 80 cents worth of preferences. We'll talk more about this later. MFN, most favored nation, investors have gotten smart and they say, look, who knows what your company's going to do? I'll give you whatever terms you insist on, including a really high valuation cap. You just got to give me, whatever terms, the benefit of whatever more favorable terms you give a later investor, most favored nation clause. I don't have on the slide pro rata rights, but that's a big one. Savvy investors will also say, look, I want a right to continue to double down, to continue to put money into this company as you go through and do later rounds. I think that's important. That's a pro rata right. You should just expect that. And it's a way of really taking care of your early investors. Okay, finally, pre and post money. So if you don't understand anything I've said so far, make sure you understand this. If you're a company, and most of the people here are from startup companies, you want to do a pre-money safe. You don't want to do a post-money safe. I know that's controversial. People are going to argue with me. I'm going to get hate mail. That's fine. I'm just telling you, post-money safe makes no sense for a company, except in that scenario when you're not doing the usual rolling safes forever and ever. If you're going to do one safe that's going to convert, then a post-money safe makes money. What's the difference? I'm going to tell you in a minute, but for now, just understand pre-money is company favorable. Post-money is investor favorable. Post-money means that the investor is getting a certain percentage of the company for their money, no matter how many other safes are out there. So if you sell $1 million worth of safes or $10 million worth of safes, that post-money safe gets a certain fixed percentage of the company. Generally speaking, there's some adjustments for option plans, et cetera. Makes no sense to me. I understand why it's out there in the market. It's easy to go online and download it, and it's easy to talk to all your buddies who say this is what everybody does. And I don't disagree. I think it is kind of the dominant paradigm. I just don't like it because I'm on the startup company side typically. Convertible debt. I think I said enough about this. So let me, again, not to beat a dead horse, but here's the difference between pre-money and post-money is that a pre-money, the safes are going to be diluted by other safes. With a post-money, the safes are not going to be diluted by other safes. You, the founders, are going to dilute all by yourself by those other safes, you and your other stakeholders. So if you're a company, you want to be careful about this. So, let's get into, before we get into some of the nuts and bolts, I want to talk about a couple other things in the market before I get into terms. One thing is strategic venture capital. It gets to be bigger and bigger, it seems, every year. And what do I mean by strategic venture? So think of your investors as being financial, the two big broad categories being financial or strategic. And by strategic, I usually mean corporate. So big corporations have their venture capital arms, right? For example, I do a lot of work with agriculture technology, and a lot of the big food and ag companies, they've established venture arms to go out and source deals. Well, they're not so much looking for just a financial return from those investments. They may be looking for a source of supply, for customers, for acquisition candidates, for stuff like that. So that's strategic venture. It's out there, be aware of it. Should you take it? Depends who you talk to. It's going to be different for sure than financial venture capital investors. One big non-legal thing that I hear and that I've experienced from doing this for a long time is that with strategic venture capital, you're going to see more frequent changes in management of that investor. And the person who just loved your company when they made the investment may not be around down the road when they're sitting on your board of directors and you need a decision. So I hear that complaint a lot, is that things change in companies, you don't get their attention. That may be a real problem when you're trying to do board consents and board meetings. It's a bigger problem if you're going to them for follow-on investment and they've fallen out of love with you because the person who is your champion has moved on to the next strategic. So keep that in mind. The other thing that you might think about is most strategic deals that I've done or corporate venture deals I've done, they look for some sort of right of first offer, a right of first look, or a right of first refusal to actually acquire your company. And that may sound great because you've got a liquidity option. Just keep in mind that depending on how powerful their right is, it may chill alternative offers and may depress the market for your stock. Now, this is something we can manage for sure, but some thought has to go into it. And we really have to understand how strong that right is and what it's going to do for the market when you exit. And by the way, when should you be thinking about an exit, right? Well, according to the book, Finish Big, which I just read, even though it's been out for 5 years, you should be thinking about an exit right from the start. Same thing with your startup company, right from the start. When you take money, you should be thinking about an exit. When you take strategic or corporate venture, you should be thinking about an exit. And just keep in mind, is this investment going to make it more or less likely you're going to have that exit? And by exit, I mean a sale or an IPO, a liquidity event, something that gets you money. I have found that strategic investors will want you to be aligned with their strategic objectives. They will have something to say about that, especially in ESG these days. We covered that last month. That's environmental, social, and governance. You better be on board with whatever their ESG policy is. And I have found that they tend to be less involved in your operations. In fact, not involved enough, because they're sometimes non-responsive. So that is just one class. You might be appropriate for strategic or corporate venture, but who knows? And then venture debt. I want to mention that this is, like it sounds, it's debt. It's expensive. There's high fees. The debt holders act more like equity holders, except that they're going to take a security interest in your valuable IP. They're going to loan you the money. You're going to have to, return that money at some point. They're expecting you to have cash flow, and they're going to have warrant coverage. What is warrant coverage? A warrant is a right to buy stock in your company. So if they have what we call optionality, they don't have to put any money in for that upside. They just have a right to buy that stock. So if I have a warrant for $1 a share to buy shares of your company at $1 a share, if the stock goes up to $10 a share, I will exercise or maybe net exercise and cash out my warrant and get the $9 when you sell the company. The stock goes down to 50 cents a share, I won't do anything. So I've got optionality with warrant coverage. Venture debt investors tend to ask for that. All righty. Let me pause on this, and then we're going to get into venture terms. Your company will be a Delaware C corporation by the time you do a venture round. It will be a Delaware C corporation. Take it from me, it's always done that way. You might not start life that way. You might start as an LLC or a partnership or an S corporation. But at close, your VCs will want to invest in a Delaware C corporation. There's a million reasons for that. I have a whole hour on why that is. You can see it on my YouTube channel, which I'll send the link around before we're done. But just trust me on that one. One of the biggest reasons is because we've got this thing called qualified small business stock, right? This is a big, big deal to an investor, VC or angel, whoever it is, as long as they're not a corporate investor. Okay, what is qualified small business stock? Well, first of all, here's what you get. If you can issue, or you as founder, if you get qualified small business stock in your company, when you sell that stock, you don't pay US tax up to $10 million or 10 times your cost basis, okay? $10 million of tax-free gains from the sale of that company. That's a federal rule, not a state rule. States go all different ways on this, but for federal purposes, you can avoid paying tax on that gain, up to $10 million or 10 times basis. That is huge. And by the way, it's not just the VC investors. You as founder qualify for this. You just have to buy that stock at original issue, right? It's not a stock transfer from another shareholder or a secondary. It's from the company. You have to hold that stock for 5 years. It has to be a C corporation issuer. Can't be an S corp, can't be an LLC. You can convert those sorts of entities into a C corp and then issue stock, but it has to be a C corp at the time it's issued. It's got to be engaged in an active business. And then there are some other little traps. You have to buy the stock when the company's worth $50 million in gross assets or less. Now, I've seen people make this mistake over and over again. And this is very US centric, so hang in there with me if you're not from the US, where they have an option to buy shares and they just sit on that option and they finally exercise it when the company just finishes its financing, establishing its valuation at $51 million. They've just, increased their taxes, by 30%, actually 20% capital gains rate. How did they do that? Because if they had exercised that option before the company had 50 million in gross assets, before they did the financing, it had QSBS. But if you wait until after the financing, you no longer have QSBS because the company fails this gross assets test. If you think you might be that kind of person, you might want to pay attention to this and go pester your company to find out if what they're worth and if you could qualify for this. Now, the Build Back Better plan, which is sitting in the Senate right now, and is, there's every day now, there's chatter on this. Last Friday, there was an 1,100-page report. I'm not quite finished reading it yet from the Senate on Joe Biden's Build Back Better plan, but part of it would very much restrict qualified small business stock for anybody making more than $400,000 a year. So keep that in mind. This is a benefit that may be severely restricted. The proposal is to limit it to 50% instead of 100% exclusion. So stay tuned. Might be some developments. Okay, suffice it to say that VCs, they like QSBS. VCs, they invest through a limited partnership usually, or an LLC tax as a partnership that doesn't allow them to invest in anything other than C Corps. They want to be able to manage their losses and not get K1s. So we don't have to spend a lot of time on that. I'm going to jump ahead. Maybe we'll come back to this, because I want to be VC focused, because the name of this presentation is how to prepare for venture capital investment. The VC's view of vesting. So you started your company, you came to me, we sat down, we had a meeting, and I said, look, you guys, there's 3 or 4 of you people, founders, you ought to have vesting on your shares to protect the company in case one of you leaves. So we all put 3 to 5 year vesting, usually 3 for founders. And what does vesting mean? It means you earn into your stock, right? So if you have 3-year vesting and you leave after 1 year, you keep 1/3 of your shares, you give the other 2/3 back to the company. You earn into it, you vest. Very standard here in Silicon Valley and pretty much everywhere else. The VCs are going to require that. Not only that, they're going to require that you unvest and revest. So you spend 3 years, you're now fully vested. Then you go to an investor and they come along and they say, yeah, we'll put money in your company, but we need to know you guys are going to stick around. We don't want to invest and bet on your team and then have the team, move across town. So to another company. So your fully vested shares now have to be unvested for another 4 years. So just be aware of that. The idea of 3 to 5 year vesting is something of a cruel joke because you're going to unvest, almost every time you do a financing, and it's a negotiation for sure. But just keep in mind that you're probably going to have unvested shares all the way to your exit, which could be 8 or 10 years out, right? A couple of other things I want to mention here, since we're talking about the market. We're seeing more IPOs now, by the way. We're seeing a lot of SPAC exits. I'm involved in several SPACs now. So it's a liquidity option that wasn't around a few years ago. So even so, most of my exits are M&A. So that's what we sort of plan for. Just keep that in mind. And also, if you take venture capital investment, the VC is thinking about this too. They got to get liquidity and they want to do it before the end of the fund life. So most fund lives, they'll go 7 years plus extensions. So if you're in the early stages of a venture fund, they might be willing to hang in there with you for a long time. If you're in the late stages, they might be forcing you to an exit before you want to exit. I like to tell the story, which you can read about in one of my books, forget which one, about the company that I represented that in 1 year, this is in 2007, somewhere around our last big recession, they were doing really well. They went and got venture financing from a fund that was nearing the end of its life. I don't know why, they invested in them, but they did. They took that money, they did an acquisition, they bought a company for $40 million. They paid $40 million for the company. 1 year later, the VC looks at his portfolio and his fund and says, oh, I'm at the end of my life. I need to start, getting rid of some companies. And they were on the board. They went to my client and they said, it's time for you to sell. We were at the nadir of a recession. It was the Great Recession. We sold that company for $30 million. Okay. A year later, the buyer, that bought that company, they had a company worth many, many times $30 million. So it was just the worst possible time in the world to sell. But we had a very insistent investor that said, look, we want you to sell or you'll never work in this town again, kind of thing. So be careful about that. All right. Don't let that happen to you, or at least know what you're getting in for. Maybe you want a quick exit too at any cost. That's fine. But if you think you might be there for a long term, make sure your investor is as well. Here's another thing going on in the market. Your company is going to have a stock option plan. An option is a right to purchase stock at a certain price. That price is going to be fair market value of the stock as of the date of grant. We all know that if you're here for part 2. Your option plan is also going to provide that a person can exercise the option, meaning pay the exercise price for the stock and buy the stock during the term of their employment or for a period of time after they leave. If it's an ISO, it's going to be 90 days after they leave. If it's not an ISO, it might be 30 days. An ISO is an incentive stock option. We don't have to get into those details today. You can read all about it on my YouTube channel, by the way. Anyway, so somebody gets to the point they're going to leave the company. They've got 30 days to exercise their option. And they say, well, gee, I don't really have a lot of money, but I really believe in this company. And I've been a good guy. I've been a good soldier. So, gee, company, can you extend that option exercise period for me? Okay. Instead of 30 days, how about you give me a couple of years, right? Because we think your company, is going to exit within a couple of years, and I'll pay you the exercise price now, which is a penny a share, but I know it's going to exit at $1 a share within the next 2 years. More and more companies are doing that. First of all, there was a time when for tax law reasons, you wouldn't do that, but we've all gotten smart as lawyers and we drafted our option documents to allow that without triggering any really adverse tax consequences. But I still hate it. I hate it because now you've got what we call option overhang. We've got so much of your company's equity eventually sitting out there in the ether where it's not stock, it's just a right to buy stock that you don't know for sure is going to be exercised. But your investors will value your company on what we call a fully diluted basis and assume that it has been exercised. So you're really giving away a lot of the company when you do that. So I discourage it. And although I've seen VCs come both all directions on this, I think they will too, because it's dilution. Super voting stock, something that I see more and more these days, because everybody heard about Facebook, how Zuckerberg controls a lot of the vote because he has way more votes for every share of stock that he has than other common stockholders. Google's done this, Snap has done this. And we sometimes see that put in place when we have a founder who wants to maintain control of the company. I talked to a company just last week where the founder has 51% of the vote. It's that kind of market where you might be able to shove that down the throats of the investors these days. I have found it usually gets negotiated away pretty quickly, but nevertheless, there is such a thing. It's a way of making sure the founder stays in control. Moving right along, some other things you should expect when you get into a venture financing are transfer restrictions on your shares. Just be aware of this. And Just understand this is the market as much as we might hate it. A right of first refusal, that means typically in the venture world, it means that you cannot sell your stock in your company without first offering it to the company. And if the company doesn't want it, then you offer it to the venture capitalist. Now, this is worth pausing on and thinking through because you want to know what might happen, right? You want to know whether the VC might view buying your shares as really important for strategic purposes. You also might want to know how this is going to chill any future sales of your stock to somebody else. Now, if you are negotiating this with the VC, I also suggest that you as founder think about a carve out. What do I mean by that? Like a pool of shares, say 5% of your stock that you can sell without having to go through this right of first refusal process. Because the ROFR, as we call it, is very much going to chill any sale activity. It's going to make it very difficult for you to go out and sell in a secondary sale. The secondary means that you're selling, you, the first buyer, are selling to another buyer. It's going to make it hard to do that. And there is a big secondary market. Now, it's not impossible because there are funds and there are methods and systems, and I've put some together myself that allow people to do futures and derivatives on this stock and get liquidity out of stock that's locked up on a ROFR. The companies, it's like a battle, the companies have gotten smart and have prohibited people from entering into those agreements as well. So, there's a whole thing. But for today, what I'd like you to know is that you can expect the ROFR, try to negotiate, some reasonable way to get you a little bit of liquidity, notwithstanding that ROFR. And secondly, think strategically how that would play out if you ever did want to dump some of your shares. Would the VC jump up and want to buy it so they can, have a control position? Lockups, you will always have interestingly, took me a long time to figure this out, but lockups, common stockholders always have lockups, right? If you're management, you're going to be locked up. What is a locked up? It means that you promise not to dump your shares, sell your shares into the public market within a certain amount of time, usually 6 months, sometimes 9, after the company is public. And the investment bankers insist on that because what they will tell you is they want to keep you from upsetting the market and depressing the price and competing with the company for capital, et cetera. You'll notice that investors don't typically agree to lockups because they view them as a way that the investment bankers get all the benefit of the IPO and frees the management out of getting the benefit of being able to sell in the IPO. What I'd like you to know from this is that lockups are just universally required for management, not so much from investors, but it's a contractual restriction. So keep that in mind. Co-sale rights, that's the idea that the investor, if you decide to sell some of your stock and you find a buyer, you have to allow your investor to participate in that sale. To drag along is just the opposite. If the investor finds a buyer who says, look, I don't want just your shares, I want everybody's shares, you, the founder, the other party to the drag along, you have to sell your shares in that transaction. Buy-sell provisions almost never in this space. And a buy-sell is the idea that I know in other parts of the country and other parts of the world, these are common and I recommend them often. I write a whole chapter on these in my new book you should read about when they work, when they don't. But a buy-sell is the idea that you, the founder or stockholder, enter into an agreement with all the other stockholders that say, look, there are certain circumstances where I get to buy or the company gets to buy all of your shares vested or not. If you die, if you leave the company, if you become disabled, if you go bankrupt, if your ex-wife levies on the shares, whatever it is, there are circumstances that you give the company the right to buy those shares. Rarely see that in startup world. Why is that? It's because fair market value is never viewed as what the value is today. It's always viewed as what it's going to be down the road. And a buy-sell is going to buy your shares at what they're valued today at best, not what they're valued down the road. So it really deprives the shareholder of their upside and their bargain. And Rule 144 is a securities-related restriction that prohibits stockholders from doing a private, basically their own little public offering, doing a distribution, they call it, meaning that it restricts you from selling your shares until after certain holding periods. All righty then. We're running out of time. So we're going to have to do a part 3, I'm afraid. So for now, because I didn't even get into venture capital terms, but I promise we'll do it in part 3. So in the time that I have left, I would like to talk about a couple of other things. So when you finally get to a venture round, for the first time ever, probably you're going to undergo really deep due diligence. And it's possible your convertible note holders took a hard look. We're doing that. When I represent an investor in a convertible note, I do diligence unless they don't want to. By the way, you following the Theranos trial? That was one of her defenses on the stand 2 weeks ago was, look, I offered the stuff to them. The investors didn't want to look at it. They didn't want to see it. Trust me, that doesn't happen often. Your investors will want to see this if they're buying equity. So here's the things to keep in mind. Number 1, intellectual property. I work with technology startups. IP is super important. You better have your IP rights in order. Patents, what you have is patentable, I believe in patents. Some people will argue with me and say, no, use trade secret. So here's my rule on that. We covered this last time. Use the patents for the stuff that can be reverse engineered, because that'll protect you. Use trade secret protection for the stuff that probably cannot be reverse engineered, right? That's kind of my rule on patents, but that's just me. The bigger issues, there's some strategy that goes into this. You should always consult a patent lawyer, which I am not, if you are going to run a tech company. Invention assignments, it's just paper. These are these documents where everybody who touches your technology, your code, your invention, your firmware, your hardware, they sign a document that assigns to the company all of their rights in that thing that they've built. If you don't have this, they might have a non-exclusive license to use that intellectual property. And if that's the case, that's a bad thing because it means you, the company, can't claim to have ownership being defined as the right to exclude others from using this property. Okay. Licenses and ownership, we talked about. Data security is a big thing these days. Just make sure that you've had all the, come up in due diligence. I'm seeing this more and more. We want to know about your data security. Are you protecting all of this stuff? Employment claims. If many of you are here in California, not everybody, but states are getting much more aggressive about employment classification. That's a big one. Google HomeJoy if you want to find out how big. But that's a claim that can bring down a company. So make sure you got that right. Tax claims, regulatory litigation, all of this stuff. Just make sure that all of this is taken care of before you get to the VC. Let's talk about a couple of these. Entrenched management and claims by a prior employer. So again, you should be thinking about your financing and about your exit from day one. And one of the big ones is going to be claims by a prior employer, because a lot of the companies I work with, it's 3 people who currently have a day job, but they come up with a great idea, or one person, whoever it is, and they start a company on the side. They do their side hustle, all right? Their Silicon Valley side hustle. By the way, everybody in Silicon Valley has a side hustle. Just trust me on that. You can't live here and you can't look around and seeing, teenage millionaires without saying, I ought to get in on that, especially now during the crypto craze. So anyway, how do you protect that side hustle from your prior employer or your current employer? Well, here in California, this is a state law specific issue, but certainly if you're here in California, California has a policy of encouraging employee mobility. That's why non-competes are generally unenforceable, except in connection with the sale of the goodwill of a business. So here in California, it would really have to be 4 things, right? So number 1, you can't do it on the employer's time. So don't be working on your startup at work. Number 2, you can't be doing it with their facilities. Don't be using your employer's computer. Number 3, it can't be the thing they hired you to do for the company. If they hired you to build widgets and you went ahead and built them even on your own time for yourself, that still belongs to the employer, or they have a claim to it, we'll say. And the important one is it really shouldn't be related to the employer's business. And it's that last one that we really agonize over. Is the thing that I'm doing too close to what I've been hired to do for my current employer? And when we get close to that line, we have to be super careful about it and careful how we position it and how we word it as well, how we verbalize it, what it looks like on LinkedIn, what it looks like in our launch. So be careful about that, because that's like a big company killer if you don't own your IP because a prior employer has a claim to it. And then finally, I want to talk about entrenched management, because that's another big problem. Not really a big deal anymore. So I won't talk that much about it, because everybody knows that you should have vesting restrictions in place. And everybody knows that if you put management on your board, they better be prepared to step off, right? But if you're not in Silicon Valley, you might not have figured that out yet. And you might have to have that vesting negotiation when the investor comes around. That's really not a great time to have to deal with it. You should have had vesting in place beforehand, or you should have management that's on board and they understand that there's going to be a negotiation. You're going to have a VC. There is a risk you're going to lose your shares because they like to play fire the founder. I'm on both sides of that argument regularly. But if you have management that just digs their heels in and they won't submit to vesting, they won't come off the board, et cetera, you're going to have a problem with an investor. And I guess the last thing I want to mention before we open it up to questions are material agreements. You're going to have to provide those to the VCs. Like I say, I do a lot of work with agriculture technology, and the market's a little funny in that particular sector. We could talk a lot about that. But one thing that I would mention is that I see this especially for ag tech companies. They earn into contracts with their customers, the farmers or the processors, the shippers maybe, and they might give away too much of their technology. You have to be super careful about that, that these agreements, here are the biggest mistakes. Number one, giving away the stuff that you're creating, giving away your own technology. Be very careful about that. I've seen companies not understand, very sophisticated companies do really dumb things. Number two, careful about the NDA clauses, confidentiality clauses. You want to have carve-outs for investors, okay, because they need to review those. That's oftentimes negotiated. Big companies will make it as restrictive as possible. So think about that. Number three, change of control clauses. You want to be very careful about what happens when you bring on an investor. If they're taking too big a share, that's going to create problems. Is this going to restrict an exit that you might have when you sell to their competitor, et cetera? Okay, that's it at a high level. I am going to stop the share. I see we have a hand. Oh boy, we have a lot of chats and a handful of Q&A. So let me, if you have questions, put it into the Q&A. And I should have done this. There we go. Should have done this from the start. Okay, so let's go to the Q&A. So we have a question. It says, what if I pay another company to develop an app which is not in conflict with my employer's line of business? I'm not seeing the problem in something like that. First of all, you're not, the only problem, I guess, if it were in conflict with your employer's line of business, you might be violating your duty of loyalty to your employer, because every employee does have a duty of loyalty, no matter where you are. So I'd worry a little bit about that. But if it's not too closely related to your employer's business, I wouldn't worry about it. I think you probably could pay another company to develop an app that is not related to your employer's business. Okay, somebody asked, gee, can you get rid of a VC if you don't like them? Good question. It's easier to get rid of a spouse that you don't like than it is a VC, right? It's probably easier to expatriate, and find a country that you like better than it is to find a VC that you like better. Once they're in your company, they're in there for the long term. You are very much connected to them until you both agree that you don't want to be there. What's Circle Up? That's the company. Go Google it. take a look. They had a problem with one of their investors. The investor parted ways. I wouldn't call it amicably, but through agreement. That's an example where it works out well. You'll find examples. The only example you hear about is when it works out well and the VC actually agrees, look, this isn't working out, buy me out or give me a warrant or something. But if they're in your company, you can't force them out. Let me just put it that way. Now, I know some people will tell you that there are ways to do that. You can do reverse mergers and freeze outs, etc. But VCs are not dumb. They're going to have protections in place that really put them in there for the long term. Once you take outside money, and not just from a VC, you take outside money, you're signing up to a whole bunch of restrictions. So you should just assume you're not going to get rid of them. You're in there till the end. VCs don't want to sign an NDA. What do we do? Yeah, let me tell you something. VCs will not sign an NDA. In fact, they're going to scold you if you even ask them to sign an NDA. At first, there may come a point when they're doing such a deep dive and diligence that you say, look, guys, you're taking a hard look at our code and you're investing in competitors. We need this NDA. Okay, here I'm going to give you a little bit more inside baseball. I don't know how this came up, but I was at a Christmas party recently, a holiday party, excuse me. I was at a holiday party recently and I was talking to a VC and somehow this topic of NDA came up. And he said, the thing that your clients ought to know, NDA or not, is that we are the biggest blabbermouths in the world. It's like if you tell something to one VC, everyone is likely to know about it. So just keep that in mind. You're not going to sign an NDA and you have to assume full transparency, right? That word is going to get around. So just be careful what you disclose until you and that VC are both, rowing in the same direction. You're both on the same team. He's in the company and it's in his interest to make sure you succeed. But yeah, you're not going to get him to sign an NDA. You're just not. The name of my latest book is 10,000 Startups. That's the question. What's the name of your book? 10,000 Startups, How Legal Strategies for Success. It is actually, as we speak, sitting at the printers. So it'll be out soon, unless they find something they don't like. But I think it's going to be out soon. It'll definitely be out on an ebook, I'm thinking by the end of the year or soon after. While we're at it, let me give you once again some contact information so you know how to get a hold of me. Okay, we are 4 co-founders aiming to raise our first VC seed in demo day. And we're, okay, you're located not in the US, I see that. Our shares are, just generally there's 1 founder that has a majority and 3 other co-founders who have minority. Is this a scary thing for a VC? Okay, so many things to unpack here. Number one, whatever your cap table is, the VC, and they not so much right now because of what the market's like, but historically, if they don't like it, they turn it into a pancake and they start over and they say, you have too many shares. You need to give some back. You don't have enough shares. We need to allocate some more to you. And you, well, your services are no longer needed. I've heard those exact words sitting in meetings with VCs for almost, meeting with companies. So they're going to reshuffle your economic deck to some extent. Not so much right now in this current market, but historically they have been not shy about doing that. Let's say that they don't want to do that. They don't want the hassle. They don't want the problem, because that's the more likely scenario these days. The VC comes along, they see that your cap table is all screwed up. We'll say it. Let's say it's allocated wrong. By the way, I think we covered this last time. If not, you can find it on my YouTube channel. We talk a lot about how to split equity, how to split the pie, and how to make sure your cap table is something that's not going to scare a VC away, and all the different methods we can do that. But let's say that you missed that day of class and you've got a cap table that the VCs are not going to like, and they don't want the hassle of going back to you and saying, please fix it. What do? Well, hopefully you've got vesting restrictions in place, right? And through your vesting, you got two things. You got vesting restrictions, so you can take shares away from somebody, the slacker partner will say, who's not doing their job, pulling their weight. And you've got a pool, a stock pool that you can give additional shares to the parties that are doing a better job. So those are really the two main mechanisms that your company and your investors are going to insist that the company use to reshuffle that deck. Now, it could be way more direct, but that's usually what we'll do to fix that. But as you can imagine, that's kind of a narrow range. And you'd like to get, so here's the two schools of thought on this. My school of thought is we'd like to get sort of close to where we think we'll end up at the start. So we want to have the shares split up, not necessarily equally, or maybe not ever equally, but in a way that reflects the relative contributions of the founders over the life of the company. That's what we'd like to do, right? I'd like a lot of things, and it's hard to ever get that. So instead, you might rely on the fact that we're going to have mechanisms in place to adjust those percentages before exit. And so first, let's try to get close so we don't scare a VC away. But then secondly, keep in mind that you're going to do, you're probably going to do several rounds of financing before you finally exit. Each one of those rounds is an opportunity to reshuffle that deck, to impose new vesting restrictions, to do top-up grants, to do what we call refresh grants, to reshape the deck. And I see that all the time. I see that all the time. Okay, so in that sense, if you're a long way to exit, your initial allocation is probably not a life or death decision. It's not a dead on arrival decision. That's the name of my first book, by the way, Dead on Arrival. It's about legal mistakes. Probably not, right? Because you're going to have plenty of opportunities to fix it. On the other hand, there's pros and cons, and I can point to stories, which I do in my books, about where it's worked out that way and where it hasn't. Zipcar is an example. Zipcar had a equal share allocation. Two founders split it 50-50. They didn't adjust it when the VC immediately, and they did not have vesting restrictions. Zipcar did really well, right? And when the two founders eventually got fired, like they always do, by then they had adjusted their shares all over the place. But it made life really difficult for the founder who worked really hard in the early stages of the business, early years, because one of the founders didn't work so hard. So they should have had vesting. They should have had something other than 50-50. But it's a good example of, how it hurt that company in the beginning. But by the time they exited, which was a good 10 years after formation, longer than that, I think, maybe 15. Anyway, by the time they exited, they had gotten an allocation that's pretty close to where they should have been. So read the story of Zipcar. Yeah, that was a long answer, I know. Which state is the best state to operate a startup, mainly with the goal of avoiding high state taxes? Well, I'll give you a hint. It's not California, okay? As evidenced by the fact that there's so few Californians on this call here today. Everyone's moved to Miami, I guess. So let's talk a little bit about that. First of all, when you say state to operate with the goal towards avoiding high state taxes, I am a tax lawyer, and I will tell you that your tax incidence is going to be based on your economic activity and economic nexus, usually where your sales are, but also where your people are and where your property is, depending on the state. So you can't just form a company in Wyoming and stay here in California or Nevada for that matter. Wyoming's the new Nevada, by the way. Unfortunately, I'm licensed in Nevada and not in Wyoming, so now I got to get licensed there. Anyway, you can't just form a company there and stay here and assume you're going to pay, zero state taxes because you're a Nevada company. You're going to pay taxes where you're located. So keep that in mind first. So find a place that it makes business sense for you to be in. It might make business sense to be in Nevada. I have a lot of clients in Nevada. If what you're doing, if you're, for example, believe it or not, energy is big in Nevada. You might be in northern Nevada if you're an energy tech company, right? So you might be in Wyoming if you're in crypto because they have a very favorable state regulatory environment. We still have to deal with our overly oppressive and ridiculous SEC and federal regulatory environment when it comes to tokens and crypto, but at least you avoid a lot of the state problems you have in the other states. So in any case, what's the best state to operate in? So if you have the flexibility of being a digital nomad and operating anywhere, you might think Puerto Rico. You can, lower your corporate rate to, you can lower your rate to 4% in Puerto Rico. Florida has no state tax. A lot of companies have gone to Miami, to Florida for that reason. Nevada has always drawn. Arizona has always drawn. If you don't mind cold weather, you can go to South Dakota. I'm from North Dakota, so I'd never be caught dead in South Dakota, but they have no state income tax. You might go there. There's a lot of states you can look at. I guess the big thing is that the venture capital, Silicon Valley has become more of an idea than a place these days. And it's because in Texas, I forgot to mention Austin, which has its own scene. And then, well, while I'm at it, I mean, if you're doing agriculture tech, like I do a lot of, Chicago, St. Louis, Minneapolis, Fargo, believe it or not. Fargo's big on software. So, and by the way, don't take it from me, just because I'm from there, don't take it from me. I've heard VCs say, yeah, we want to go invest in Fargo because they've got such a big software community, because Microsoft had a big campus there. It's a long story. Anyway, there are a lot of places you can be. You don't have to be here in California, where we pay a 13.3% tax rate on upper at the top tier. You can be in places, and we're talking about a wealth tax. You can be in much lower tax places. My friend Martin Babinek is developing an ecosystem in northern New York, upstate New York, where he talks a lot about what it takes, to create a startup ecosystem. Now, having said that, personally, I'm still here in Palo Alto, right? I work for a Texas law firm. I'm licensed in 6 states. I'm still here in California. This really is the center, I think, of the startup universe. It really is a rainforest. There's just so much here that's immediately available. And we do a whole presentation on this, by the way. You can see it on my YouTube channel about why companies should be here and what the pros and cons are. There's big markets. Probably half the venture capital in the country is here, probably less than that now. Probably a quarter of the venture capital is here, right up Sand Hill Road, right down the road from me. And talent, there's a tremendous amount of talent. So, but your question was around taxes, and the answer is find a tax haven state and actually move your operations there, but be prepared to pay taxes based on economic standards on where you do your sales. All right, I'm working for a tech company. I've hired some developers to work on a platform. So this is your side deal. Should I quit before I launch the app to be on the safe side? Well, I don't know enough from that question to know, but tech consulting. So question number 1 is, what does your employment contract say? What state are you in is big. And is this app that you're launching, just go through my 4 factors. Number 1, did you develop it on your own time? Did you do it with your own facilities, not your employer? Is it the same thing that your consulting company hired you to do, your employer hired you to do? And the 4th one, is it like related to that tech consulting company's business? So let's just go through the factors and determine whether you need to quit your day job or not before you launch your side job. A lot of startups, they keep their day job and they do their startups on nights and weekends until that startup gains traction. It's a very common scenario. So you shouldn't be afraid of that. Just make sure that, you're under your applicable state law, that you have not basically created a bunch of IP that your employer owns. Should I incorporate my startup before going to a VC? Yes, absolutely. For so many reasons. Number 1, the VCs will only invest in a Delaware corporation. That's the biggest one. So ideally you would be one when you got there, but you could be a corporation by close, theoretically. You could talk to a VC and say, look, I will be a corporation that you can invest in by the time you give me the money at closing. I think the only time I see that work is if you're already a business entity, like a limited liability company, and a closing condition is that you'll convert. And you'll actually convert like a few days before, just so there's no glitches. But the bigger reason for incorporating is that you really want to have an entity that can, number one, split up equity among your stakeholders, your founders, your advisors, your mentors. Number two, can gather and hold intellectual property rights, especially if you're a tech company developing technology. You want an entity that can own all that. So there's really good reasons to form a business entity. And if you know VC is your path, you may as well form a corporation. There are scenarios where we would do something other than that, but VCs will invest in corporations. Do we have a similar class for angel investing? Yes, we do. We talk a lot about that. Again, you'll find it on my YouTube channel. Could you raise more than you asked for if you have a killer presentation? Could you raise more than you asked for or need? Well, certainly you could, but you wouldn't want to. So here's the thing. I'm glad you asked that question. We talked a little bit about this last month, but let's kind of return to this. When you do your financing, what you want to do is you want to take enough money in your financing to get you to the next valuation event. You don't want to take more than that, because if you take more money than that, you're selling your stock at too low a price, right? Because your next valuation event hopefully will be an up round. So you want enough money to get you to the next valuation event. Maybe that's an FDA approval, maybe it's a product launch, maybe who knows, whatever it is, whatever will bump the value of your company. And you'd like that next valuation event to be 1.5 to 2 times your last valuation. That's what you'd like to have happen. And you'd like to have it happen like, I don't know, 1.5 to 2 years out, right? To give you enough runway. I mean, so you want to aim for stuff like that. So if you take more money than you need, so it lasts you longer and it gets you past your valuation event, like I say, you've sold the stock at too cheap a price because you could have just waited and taken it later at a higher value. That's all theory, right? But people actually do it that way. I know, as a lawyer, I see a lot of deals, and sometimes I see some that are just so great. I say, hey, good client of mine, can I buy some preferred stock in this round too? Just a little bit, just a little bit. I'm not greedy, just sell me a little bit. And oftentimes, it's happened more than once, it's happened a lot. VCs will come back and they'll say, no, you can't. It's all for me and you can't have any. So that's how you know they're applying a strategy. They're taking only as much money as they need to get to the next valuation event. Not even my measly few $1,000s more. All right. What about foreign talent and offering a vesting schedule to attract them? I've got nothing against foreign talent. I mean, this is, like I say, Silicon Valley is an international idea these days, and it's a pretty rare company that doesn't have its tentacles all over the world. The thing is that startup companies go global almost immediately in today's market. It wasn't like that at one time. And especially here where I'm located in Palo Alto, startup, first of all, half of the companies I work with, even if they're here, probably come from another country, at least half. And they're thinking about markets in another country as well. So it makes sense you would have foreign talent. Now, if you do hire people in other countries, I had this conversation just last night, you are going to have to comply with the laws of that country, right? So if you have an employee in the UK, you have to comply with UK law. You might also have your California overlay because you're a California corporation or a Delaware corporation headquartered in California, but you're definitely going to have to comply with the law where that person's located. So keep that in mind. That's number one. Number two, having a person in that foreign country, like Canada, is likely going to result in what we tax people call a permanent establishment, which that means is that you have a taxable presence in that place. So you have to get into their system. You have to qualify or register, pay taxes, do some sort of allocation, etc. So these are big decisions when you hire foreign employees. A lot of times what my clients will do is they'll start off with contractor relationships. And in a lot of countries, you can rely on that so they don't have all the compliance burden. But but still you have a contract with somebody in a foreign country. Europe in particular, European law is going to apply to that contract no matter what you say to the contrary. Been burned by that once or twice myself. All right, here is somebody who is developing Uber for something. I can't tell you how many companies I've seen that are Uber for this, Uber for that. Okay, this is Uber for cats, I guess. To what extent can I use patent to protect my app, or is it not possible at all? It probably is. Now, the patent law changed about 10 years or so ago to make it much more restrictive and harder to use for business methods. So, and that covered a lot of software patents. But nevertheless, patent is alive and well, and I think it's well worth looking into. And the patent bar has gotten smart enough to figure out how to draft their claims to fit within patent protection, so that we're not just a business process anymore. It actually is an invention that's patentable. So yes, you should absolutely look into that. Patents are important. They will help your valuation as long as they're good patents. So here's somebody who's thinking of starting a VC fund. Do you have any advice to VC managers? Yeah, again, sorry to sound like a broken record, but we have a YouTube video on that. Actually, we have several of them. You'll find them on my YouTube channel. We have several hours on how to form a venture capital fund. Check it out on my YouTube page. When you plan to get in more detailed discussion on the role of IP in VC financing, how important is it to have strong IP to get VC financing? You know, that kind of depends who you ask. We covered this last month. There are quant investors, there are thematic investors, there are people investors, there are people that bet on the horse, and investors who bet on the jockey, and investors that just, they don't bet on either, they bet on the racetrack. So among all those metaphors, what I'm trying to say is that some VCs put way more importance on the team. And I've had companies, in fact, I had an ag tech company, don't want to say which one, a few years ago that attracted a I was company counsel, attracted a very famous investor, venture capitalist. He put a lot of money into it. I was company counsel. It was ag tech. So I understood it really well. And I understood that their technology was not the best in the market. Not even close. And years later, after that company failed, I ran across that VC and I asked him, I said, I've always been meaning to ask you, why did you bet on that particular company? Because I know you as a tech-centric investor instead of some other company. And he said, because they had the market share. We can build the tech. We figured we could build the tech. That's the easy part. They had the market share. That was the hard part. So it kind of depends on the investor. Some investors, Jurvetson is well known for being very focused on the technology, right? Draper is well known for being very focused on team. So it kind of depends on who you're talking to, and it kind of depends on the company. I personally think IP is super important, and IP protection in particular is super important. Okay, I'm going to have to defer on these patent questions because I am not a patent lawyer, but you should always talk to one. Do VCs like to collaborate with angel investors or seed or not? Okay, so here's the thing about angels and VCs. The best, and we do a whole thing on this, you'll find it on, in fact, we covered it last month. When you go talk to angels, you're going to have your first money in because you just need money. And by the way, if you have questions, put them in Q&A, not in chat. I'm not looking at chat right now. The best angel investors are going to be the ones that have so much credibility, they can get you that introduction and get you in the door with the venture capitalist. So in that sense, yes, they do collaborate. That's the good story. You have an angel investor, they got good relationships with VCs, they can get you in the door. The bad side of this is that a lot of VCs are not known as being the sweetest guys in the world, and they will come along and they will say, oh, angel, you got angel investors and you gave them this deal. That's great. We're going to take that all away from them, right? We're going to recap. If you want my money, we're going to really take advantage of the angels. They got to give up their pro rata rights. We're going to, adjust the valuation. We're going to give more stock to the founders, etc. So that used to happen a whole lot more in the old days. In today's market, not as much. I could tell you stories. So some angels just won't allow that, right? And they'll continue to position themselves what's best for them and the company, as opposed to being taken advantage of by later investors. And like I say, I just don't deal that much with VCs that are like that anymore. There was a time in this valley when it was a lot worse. And I know people are going to argue with me about that, I'm sure. All right. Where do I find mentors? Well, you should hang out on the Idea to IPO website and use the chat features to ask people if they want to get involved in your company. When we start doing more live events, which we started to do again, you'll be able to meet people in person. And there is a large mentorship community here in the Valley. And they're not hiding, you know, but you'll look around, you'll find them. All right, with that, we are at 10:30 Pacific time. I am going to close the questions. I want to thank all of you for being here. My name is Roger Royse. I'm a partner with Haynes Boone. I'm in the Palo Alto office, and this has been Preparing Your Company for Venture Capital Investment Part 2. Thank you all for being here, and we'll see you next time.